Well, thanks for joining me. Brett, up here and standing in for Kathy Wood. Big shoes to fill. She's sick in New York with the flu.
Yeah.
Brett, why don't we just quickly start off and give a little bit about your background before you got to ARC. And for those who don't know, ARC is the first traditional institutional investor in the U.S. to actually invest in crypto. So they've been blazing a trail, and they continue to blaze a trail.
Great. Yeah, so I'm Brett Winston. I direct research for ARC Investment Management. Kathy and have directed research since its inception in late 2013. Kathy founded ARC explicitly to invest in disruptive technologies as they manifest in public equity markets and within publicly traded vehicles. And she thought that given where we are in kind of the history of technological development, now is the time to invest in disruptive technologies because there are so many fundamental platforms, including blockchain, that are kind of entering into their fruition today.
And you guys had worked together for a number of years before ARC at Alliance.
Yes, yeah. So I've always done what I call thematic research for investing. Kathy and I have worked together for a decade. And the fundamental idea and the inefficiency that we seek to exploit is really to look over a 5 or 10-year time horizon and do fundamental valuation on what is the technological landscape going to look like, and then what are the underlying assets with exposure to these technological developments going to be. And so I've done that all along, working alongside Kathy.
And so when you formed ARC, you formed it at that time with kind of the 5 major themes?
Yeah, so we invest in blockchain. We also invest in gene editing and sequencing. We invest in what we call next generation internet, but it's inclusive of deep learning and mobile connected devices, in robotics, and then also in autonomous mobility. So these are all what we see as transformational technologies, the kind of technology that 10 or 20 years from now, people will look back and say, that was as big as the computer or as big as the internet. And if you look at the history of technological development, you've never had so many kind of, potentially disruptive technologies entering the marketplace at the same time. So that's why we think it's a really unique time to invest in this style.
So obviously we're at a crypto conference here, so why don't you start about talking about your kind of the theme and your thinking around crypto and how you're thinking it's going to evolve and how you're investing in it.
Yeah, so we began due diligencing kind of blockchain and crypto, Bitcoin specifically, at the inception of the firm, so in 2014. Chris Bernisky, who was our crypto analyst, he's now started Placeholder Ventures along with Joel Montenegro. Chris had to write a white paper for us to invest in Bitcoin. So instead of writing a white paper to actually raise a bunch of money, he had to write a white paper to kind of due diligence the investment in Bitcoin. And that took him about a year. We did a lot of fundamental...
And he was like 12 at the time? How old was he?
Well, part of the exciting part about investing in emerging technology is you really have to have young talent that is passionate about it and is interested in continuously learning. You can't become an expert and just stop, I think, in this time in economic history. You have to always be kind of climbing that mountain of learning. And so we published a paper called Bitcoin, the First of Its Kind, in a new asset class, kind of prefiguring the idea of the altcoin space and the crypto asset space as a whole.
And this was 2014?
That paper was, I believe, 2015. So it was very timely. And from an investor perspective, to me, the case didn't have to be that compelling because it's such an idiosyncratic asset, right? Like, you as a portfolio manager, you're always looking for bets that are non-correlated. And so, if you can see the potential for asymmetric upside relative to your risk, then you insert it into a portfolio and it provides you with great risk-adjusted return over time. So then within how do I envision the crypto asset space developing as a whole? I think cryptocurrencies are interesting on their own. I think that as you move down the crypto asset stack, it's likely that crypto assets or crypto tokens will become an established part of corporate balance sheet structures where You have fixed income that you issue that is a claim on the fixed assets of your company. You have equity that's a claim on excess cash flow. And then tokens are a claim on the bandwidth throughput of those fixed assets. So you could imagine that Twitter might be a better platform if people were charged per tweet or per character. And so a native token would be the only way that you could actually efficiently charge those microtransactions. And so you could imagine a future scenario where Twitter issues a tweet token and thereby actually improves the quality of the content that goes across their platform by establishing a marketplace for the bandwidth through the network. So I think that's the medium-term vision. I think the work that we did that I thought was really worked out was we looked at when assets emerge as asset classes, as a new asset class. So when it gets recognized as an asset class, and then how long it takes for that asset class to appreciate above a certain value. And so we looked at fine art, we looked at mortgage-backed securities, we looked at high-yield bonds. And so between the time where somebody said this is an asset class or somebody attached an index to it, it took institutional money and all the legal infrastructure around it at least a decade, if not more, before that asset accrued to more than $1 trillion in value. And so when we were approaching the height of the most recent mania at the end of 2017, and crypto assets were 800 billion or so, that felt too early to us relative to the amount of kind of infrastructure development you have to do on the legal and regulatory side to kind of motivate money into it.
So if you're talking about 10 years,
yeah.
On average, when did this start?
Well, so we tie it to our own paper, which is first of its kind as a new asset class, so 2015, say. So we would say to sustainably get above $1 trillion, at least, and this was heavily internally debated, yeah. It would require to 2025. And so then the counter argument, of course, as well, it's like things are moving faster now, it's kind of digital, not non-digital. And the actual exception case was the dot-com companies collectively, which traded well above $1 trillion. They got to 4% of global GDP on an equity market cap basis before collapsing down below $1 trillion. And it took 15 years before they were sustainably as a whole above $1 trillion in market cap. So, I mean, from here, we're at something like 300 or 400 billion. You have like a fair amount of appreciation to go, but I think that people underestimate how much $1 trillion actually is. Like, it's a lot of money, and so you need not just the legal and regulatory development, but also to bring kind of the pension funds and all of the major institutional money into a level of comfort with what the assets are and how they should be valued and treated.
So digging a little deeper into the work that Chris Berniske did and you continue to do. I mean, he's really, I think, been and he started this obviously when he was at ARC, a trailblazer in trying to value utility tokens.
Sure.
How are you guys thinking about that? Do you think that it's possible to value a utility token? Do you think it's important to be able to value a utility token for it to to get to that $1 trillion mark?
Yeah, I mean, it's possible. Yes, you can assign a price to a fundamental value to anything. I think that conceptually, when you own a utility token, you own bandwidth through the network, and you can do so. I've done kind of really a toy calculation, but the social network at maturity. If a social network is global in scale. And you're generating 15 cents an hour off the users on that network, and then you would say enterprise value, so with a traditional equity, it would be worth roughly $1 trillion. And then if you convert it into a protocol, so you lose all of the profit margin that was previously going to the Facebook or whoever, and instead that's all paid back to users to incentivize them to participate, depending upon how the velocity of the token, how frequently it changes hands, basically, you can massively reduce the value of that protocol relative to the equity value on the order of, depending on your assumptions, 25 times less valuable than the equity value of Facebook or a global social network, or maybe 1,000 times less valuable. And so kind of there's this velocity piece that's very kind of challenging to calculate or say what it's going to be. I think there's a panel right after this where Alex Evans has done some good work saying what that velocity could be. But you're going to have to get to where these things are traded based on some fundamental value, for them to sustain as assets. And I subscribe more to call it the velocity thesis, which is if you massively reduce the friction in trading in and out of an asset, then most of them will have extraordinarily high velocity, and so most of them will actually not be worth very much at a protocol level, with some handful accruing a substantial portion of the value as essentially the reserve currency for all these other assets. But there are arguments for and against that.
Right, I mean, that's one of the most counterintuitive things about the valuation work being done in utility tokens is the fact that it's the exact opposite of what most people think, right? The more it's used, the higher the velocity, the lower the value.
Well, right. There's
All
like
else being equal.
there's use like if it's a Dentacoin like number of root canals that are paid for with Dentacoin, right? But then there's also like what is the incentive to hold on to that Dentacoin after you pay for the root canal, or I'll genericize it, social Facebook token or whatever, and so it's not so much that they are used less, it's that why would I hold my money in that asset that's only good for paying for content on this social network, as in a more kind of generic currency that can be deployed into all of these different tokens very frictionlessly. So I actually think one of our theories is that the wallet provider layer is a really, really important strategic layer. Because if you imagine that I'm providing consumers with the wallet by which they decide which social network token to purchase, and then in what amount do they purchase it, even if they're buying like a microtransaction bit of content for 10 cents, that can drive a lot of the value of these different assets. And so kind of over the medium term, whoever is sitting at that wallet level has a lot of economic control based on just the defaults they impose upon the users themselves.
Wow, really interesting. With the few minutes that we have left, can you talk about, because again, crypto is only one of the 5 technologies you guys focus on. Can you talk about the synergies between the work that you've done on crypto and how that has made you a better investor in other areas, and how investing in other areas has made you a better investor in crypto?
Well, I think it's fair. What we try to be good at is to be comfortable making assertions about assets where there's a lot of uncertainty, right? And so in crypto, there's a lot of uncertainty. And so the work, and even from a first principles perspective, saying, well, what is this worth and why should it be worth that? That, I think, is actually a transferable skill to these other technologies. There's also so much crossover between the technologies. The autonomy guy was up here talking about Internet of Things and how crypto interfaces with that. I think that there's a lot of health crypto, like deep learning. Basically, if data becomes very valuable for training these algorithms, shouldn't you be compensated as an owner of data for your part in helping to train that system? Like, these are all areas where there's intersection and overlap. And so because we're focusing on these really fundamental changes in technology, it helps us understand kind of the whole ecosystem as it's going to develop.
And maybe just to dig down a little bit deeper in that, I know one area where you guys have really been thought leaders on is on genomics and CRISPR and what's going on there. Has there been much overlap between that work and the crypto work?
Well, I think that there's certainly there's one of the major problems with certainly the U.S. healthcare system is there's a lot of friction in data transfer. And so we think that blockchain provides a potential solution to that, to allow patients to easily share their information across providers or in contribution to research projects. There's it's an Alzheimer's, candidate Alzheimer's drug. It's based on the genetic information of people in a Norwegian country or a Nordic country, but they're not being compensated for that. So, like, if you have a very unique genome, like, shouldn't there be a way by which you're incentivized to provide that information to medical researchers. And so that's kind of an angle that we're interested in.
This kind of reminds me of Henrietta Lacks. If, you know, she had the original work that's been done, and now I can't even remember what it was, but that all of this medical research was done on. So last question with the little bit of time that we have left. From an investment standpoint, what are you guys excited about in crypto?
What are we excited about in crypto? Oh, I'm excited for some more violently flat. That's
yeah, violently flat.
Yeah. I mean, you know, I think I'm excited to see how the space develops. I think that there is a lot of great infrastructure work being done right now. I think the Lightning Labs work is really great. I mean, I think second layer scaling is, to me, a very obvious solution and really exciting. And I think, you know, I think over 3 years we're going to be like astounded by how far the technology has come, but I don't know that that will be reflected in prices at all over that same time frame. So.
Okay, terrific. Thanks a lot, Brett.
All right, thank you. Thank you, Lou. Thanks.